and welcome to another episode of Purple Ponderings with Pankaj. And today we have with us David Gritz from Insurtech, New York. David is someone that I've wanted on this show ever since I became a participant in the events that they host, and I was very impressed. So, without going any further, David, do you mind just sharing a few minutes and telling the audience your background and also highlighting one thing that most people in the outside world don't know about you?
Sure. Yeah. Pankaj, well, really appreciate you having me here for this show and welcome to the audience. I'm glad to be here. So happy to share a little bit about my background and kind of how I got into the Insurtech space. So my journey into the Insurtech world started about 6 years ago when Insurtech was barely even a word that many people knew, and it was a new word at the time. I was part of a captive-based insurance company. And for those in the audience that are not familiar with captives, they're essentially a vehicle where you can domicile an insurance company in a single state and kind of transfer over what that state has into other states. It's a risk-bearing entity, similar to a traditional carrier, but has much lower capital requirements. So the organization focused on workers' comp and commercial auto. And essentially, they had a problem where people that were the owners of the captive, which were 36 industrial companies, their employees kept getting similar injuries where they would climb into a truck, overreach their arm, injure their back, and be out of work for multiple months, which was a lot of money taking away from the captive. And the goal of a captive is ultimately to keep losses down as much as possible, because essentially the retained earnings or the underwriting profit goes back to the owners of the captive to either reinvest in premiums in the next year or just simply to go back to the owners. So there's a big advantage, just similar to self-insured program. So my friend who had run the captive for many years reached out to me and said, hey, we've been having this problem. I'm really hoping that maybe you could help me with this problem from a technology perspective, because just doing training is not really making the difference. So I said, hey, at the time, I don't know very much about insurance. I know of it from a cursory standpoint, but I definitely know how to build products. So I'm happy to help you. So I came on, the company was called Zero. I led their product essentially from the standpoint of early idea phase, building it, working with our first beta client, growing it to the point where eventually Everest acquired the company. From there, I spent some time advising other startups on product. I spent time in Silicon Valley working with the Silicon Valley Insurance Accelerator, SVIA, to organize their events and run their membership program. And in that kind of time period, I realized that even though there was a lot of great things happening in Silicon Valley, there were good things happening in Hartford and in Des Moines, in New York, there really wasn't a dedicated community for Insurtech and insurance professionals that are looking in terms of the future. And if you were around in the 2018, 2019 timeframe, pre-COVID, there were fintech meetups you could go to in New York once or twice a week. But as an insurance person going to a fintech meetup, you were like the ugly duckling. You would go there and say, hey, I'm working on this Insurtech startup. And they would be like, what's Insurtech? Or they would say, basically point their nose down at you and say, what are you doing? And I thought that that's not right, because the insurance industry makes up 8% of global GDP. It is resilient and helps a lot of people. And Insurtech is hot. And back then, it wasn't as hot as it was now, but it definitely warranted having a dedicated community in New York. So I partnered with my current business partner, Tony Liu, and we created Insurtech New York. We started as an events organization. We evolved into a membership organization as well. And now we're in the process of growing our fund to be able to invest in early stage startups. So that is a little bit of my background in the Insurtech space. I think one thing that people don't know a ton about me, or that don't know me very well don't know, is that I used to flip houses in Philadelphia. So that is my kind of blue collar connection to the universe of claims and property and risk management is understanding from the perspective of someone who manages tenants, who improves homes, and also goes through that entire cycle. So it gives me a little bit of a different perspective from the P&C side of things, really understanding that.
Wow, that's really interesting, David, and thanks for that nugget. I was going to ask you, what were you doing before Insurtech? And I think you kind of answered that, because I assume that you did the house flipping outside of that, last 6 years. Because if you did, but if I'm mistaken, tell me right now, because then I'll think of you now as a Superman who's, done all these different things within Insurtech and flipped houses.
Well, so there are a few other things. So flipping houses had some overlap with Insurtech, but most of it was before. But prior to being in the Insurtech space, I ran a business called Hatch House Ventures, which was an incubator business. So we set up a network of 3 different incubators that were partnered with universities, one in Delaware, one in New Jersey, one in Pennsylvania. And we helped entrepreneurs that were graduating from college. But one thing that you don't think about as university entrepreneurs is they lose all the resources when they graduate. No access to the wet labs, no access to 3D printers, no access to the great mentors that are professors at the school. So we partner with the universities to support their alumni in their entrepreneurial endeavors. We had sort of, if you think from the West Coast perspective, hacker houses where the entrepreneurs live together to keep their costs down. And then we had a sidecar business called Helium IQ, which was a software company in the community management / ed tech space where we sold to universities to help manage their entrepreneurs. And then before that, I was in the technology consulting space. I led partnerships at a company called Computer Aid, which essentially was like, I think the best way to describe it is a small Accenture. They did IT outsourcing for companies like MetLife, DuPont, and Royal Caribbean. They had development offices all over the world. And they also supported 11 states in the United States to essentially be their primary vendor manager. So if you wanted to be an IT person working in Illinois or Pennsylvania, you would go through Computer Aid. So that was how I really got into the technology space. I was fortunate enough to get hired by the CEO, who was one of those OG entrepreneurs. He left IBM after a 25 or 30-year career as an IBM salesperson to then start Computer Aid in 1981 and grew it with no venture capital and no debt to be nearly $1 billion in revenue company, 7,000 person company. So I was very fortunate to be mentored as an entrepreneur directly from him. And that's where I kind of got my technology and entrepreneurial chops.
That is absolutely amazing. But I guess the thing that stands out is your deep, sort of a background in the startup ecosystem, right? You've been in that ecosystem for a while. You've done different gigs, but in some ways or the other, I just feel that you've always been connected in this whole, I think of, the whole startup ecosystem as a creative world. So you've been very creative from that standpoint in coming up with, different kind of experiences. If I were to ask you, David, with this very rich and varied experience that you've had, what would be the single biggest sort of, I would say, mistake that you see a lot of the startups make, as well as, on the enterprise side, right? So a lot of the enterprises want to be innovative and want to try out different things, but they struggle. So I just wanted to see from both those perspectives, what's been your observation?
Yeah, so that's a great question. The one area that I think is founders make the biggest mistakes, I also think people in corporate innovation make the biggest mistakes, is not listening to the voice of the customer and not using the customer to shape your product, but just jumping right into things. And a lot of people get really afraid that if we go reach out to people and they tell us that it's a bad idea, then we'll not have anything. But you have to kind of take off that ego and realize that you're not going to have anything anyways if you go build a product and then try and sell it to people. And personally, Tony and I went through that experience with Insurtech NY. We had gone out, we had studied the market to realize what we thought was the opportunity, obviously, to run events. But our original hypothesis was that insurance carriers didn't really like accelerator programs, and they just wanted essentially a program to help them do scouting and find the startups that were exactly what they were looking for. So we had this theory that we could offer a service that would be tied into our community and would just be purely focused on scouting. So this was 2019, kind of the first year that we were running. We went to Insurtech Connect, and our goal was to validate whether scouting was real or not. We talked to about 40 insurance carriers that year. And the resounding fact was scouting was not what people wanted. They didn't have a mechanism to buy it. They weren't interested in purely scouting. They were looking for something that was more programmatic that could kind of tie into what they were doing and augment what they were doing, not replace what they were doing. So it validated a few things. One, that some of the groups that existed both in the US and internationally that were tied around an accelerator program. So you think, actually, based off a conversation I had earlier today, Insurtech Munich Hub, which is one of the strongest member-based communities. They have an accelerator program. They do some events, but it's all tied in through their membership program. And there was kind of this foundational set of programming that had to do with an accelerator and events. And ultimately, scouting wasn't the primary lead. It wasn't the language that people were looking to buy from. So we went back to the drawing board and realized that if what was working in other areas, like in Munich, was an accelerator program, or with Startup Bootcamp and what they were running in the UK and in Hartford, then that's the foundation what we needed to create. So we had to almost throw away everything that we did, which was probably 6 months of work in trying to define that and figure it out and research it. And it was only through going to the market and really learning what people want. And that concept of understanding the needs of the market is a universal thing. It happened with Insurtech New York. It happened when I was building Zero. Originally, we had a premise that we would build something that was specific to the members of the 36 companies in our captive. But in actually talking to them, we realized that one, they had diverse needs, and two, just because it would work for 36 doesn't mean that it would work for enough of the market to make our company grow and be profitable. The segment that really needed our help was manufacturing. And it wasn't until I spent a lot of time with the risk manager at Bebron to understand the challenges inside of a manufacturing plant, which obviously could scale because there's lots of manufacturing plants, and go out to other people. Like one of the early advisors we brought on was Paul O'Neill, who is the CEO of Alcoa, kind of a safety legend in and of itself. But by understanding what he implemented at Alcoa and how that was related to what Bebron was trying to do, that we really could build the right product. So I think you got to put your ego aside. You have to really go to the market and talk to people and understand and build your product around what will work for the market, not just what your hunch is what will work.
Got it. Yeah, certainly. I think, and that was a great answer because you also wove in your own personal story, the Insurtech New York story, with what you started at versus where you want to go based on the sort of the opportunity out there. So I wanted to segue into something which I think you're in a great position to provide a perspective on, which is right now Insurtech and sort of the funding right within Insurtech, all the stories and the visibility and releases, you see it's almost like a perception that there's just a lot of money, right? That people have a lot of money that they're investing in. And so if you're an Insurtech, then funding is available to you. And I always think there's a hype version and there's a reality version. So just wanted to get your perspective on the sort of the funding situation in the Insurtech space. And what do you think about it?
Yeah, so the funding has really evolved over the history of Insurtech from 2015 till today. If you were to look at 2015, 2016, even 2017, there was a lot of funding for early stage startups, meaning startups that are still building their product. They don't have any revenue yet in that kind of pre-seed and seed stage. And because that's all that was out there, right? There were only startups that were in those early stages. You look like that was when Lemonade didn't even have licenses yet. It was when Hippo was an early company. Policy Genius was only in business for a year or two. And in that process, so to speak, if you were a new venture fund, you were also proving yourself. So you had a smaller fund. So smaller funds invest in smaller rounds. But as the Insurtech space has matured, funds have become bigger. Also, traditional corporate venture capital funds have matured. They've made some bad investments in seed stage companies that have gone out of business. So they've kind of stepped back and said, I don't want to be in the riskiest part of the curve. Let's invest in Series A. Some other investor has already pre-vetted it. The companies have revenue. There's things that we could look at that are tangible to prove traction. So what's happened is industry where it's really supported the earliest seed stage companies have now all moved upstream. And I mean, there's some groups, like you look at the Hudson Structures of the world, that are focused in like Series B and later. So that's a representation of a more mature industry that's had time to exist and mature. And because of that, what's really started to happen is there's become a gap in terms of that pre-seed and seed stage funding. So if you are a company where the founders are well enough off to, I would say, bootstrap the company to the point where you have revenue and you could kind of get a later seed or a Series A round, I would say the market is at your beck and call. You can get really good valuations, you could get good terms. There's a variety of companies that will invest in you from a venture perspective. But if you're a founder that's not fortunate enough to already have a successful career in the insurance industry or another industry or have a previous exit, and you're starting from the point where you're working right now, you're just trying to get enough of the product done or enough proof to leave your job, you're going to have a struggle because those types of startups have essentially not gotten the focus of recent because the traditional groups have all moved upstream. Even angel groups have moved upstream. So getting angel investment, there's a very limited number of Insurtech or very dedicated Insurtech angels. You're kind of stuck in this world where you have to fund it yourself with your IRA or get friends and family that believe in you, but it's tough. So that's why we've kind of come onto the scene to create our fund to really help companies in that pre-seed and seed stage and really to invest in them and help fill in that gap. But we definitely should not be the only ones. There are a few other funds like in the West Coast, there's Sure Ventures run by Gopi. He's done a good job to help in that space as well. In Chicago, there's Sandalphon Capital. So there's definitely people that are out there that are doing it, but there needs to be more. So we definitely want to help encourage that.
Yeah, that's a great perspective because, as a early stage company ourselves, and by the way, early stage means so many different things to so many different investors, especially. It's not even funny, but we've personally felt exactly what you talked about, and I know Gopi really well, and I would agree that he's a great friend to startups. In fact, when it comes to investors, there are not many people that I can think about who genuinely want to help startups, right? So he's one of those. But it brings back to, I think you just to offer a point here that it is tough, especially in the pre-seed stage. It is especially tougher if you're a first-time founder, and it's even more tough if you don't have the financial wherewithal to bootstrap to a certain extent, right? So in some ways, I feel that just wanted you to acknowledge and validate if this is the kind of the takeaway, which is that right now you do have to do those things yourself. You get yourself in a place where, whether that's an angel or an institutional investor, for them to come in, you have to really, de-risk something within the development of your idea.
Yeah, I mean, there are certain pathways, or if you think of it as a like video game analogy, cheat codes that can help you get past that really tough stage faster. So for founders that are in that stage right now, some of the things that they can do is, I think, if you can cut your development costs by having one of the founders be a developer, then that will allow you to get to the point where you can have an MVP without paying $20,000 or $50,000 a month in development, which for people that don't have the financial wherewithal, that's very difficult. So I think that's one cheat code, so to speak. Another is the earlier on you can to bring in a senior executive from a previous insurance company or someone who's had a previous exit to either be a very active advisor in your company or to be a co-founder, that's going to give you a tremendous amount of credibility. And maybe even they want to invest a little bit in the company to kind of validate their belief. So that's something that you can do. And the other thing that you can do is you really need to find that first customer. That first customer is going to make all the difference, especially one that's willing to co-develop it with you. And what I've seen a lot is people that come from an existing carrier or existing broker, they oftentimes can leave and bring their relationships from that carrier and broker to be that first customer that will co-develop with them. And the other kind of cheat code, so to speak, is to join an accelerator program. Accelerator programs understand that you're in that stage, like the Global Insurance Accelerator is a perfect example in Des Moines. And they have some of the companies that are willing to co-develop and test and learn with you and really dive in and help you to build your product. So that is another pathway to take. But by no means is any of this easy. Just finding a co-founder that's technical for some is a pretty difficult thing.
Yeah, and I would just provide my color commentary. I mean, all of those things that you said are really good ideas, but there is a con to the pro on each one of them, right? As I see it. With the accelerators, what I've seen over the last 3 years as I have applied, and I always do a post interview with the general partner there. What I'm realizing is that even the accelerators are becoming, in some ways, like financial investors themselves. So the lens that they're looking at is no different than how a early stage institutional investor looks at the startups, because it's also demand and supply. Usually they want to select 10 companies, 12 companies, and there are thousands of companies applying at this point, right? So for them, it's becoming also harder. So they obviously want to make the bets on the serious ones. I will say one thing on the co-founder idea, that you're absolutely right, that if you want to go the startup route, I strongly encourage the team route, because it's hard as a co-founder. But at the same time, the riskiest decision for you to make is who is going to be your co-founder or your co-founders, because that's the only decision you cannot undo. You can have a wrong market hypothesis, which a lot of the startups do, but if you're aligned, then you move along, right? You do the thing. So a great answer, David, but maybe we'll do that offline, because this podcast will not be, in the minutes, but it'll be in the hours if we get into this conversation. So this is great. Great answer. I love this inputs coming from you. So with that, I wanted to segue a little bit into kind of your own observations around specific technologies, right? Our background and the way this podcast started was more around IoT as one of the emerging technologies that we sort of, honed in on. But from a podcast perspective, we want to broaden out, right? So there are other emerging technologies that have impacted the insurance world, right? We've seen everything from blockchain, AR, VR, ML, AI, although AI, ML is no longer that emerging anymore, and crypto, right? So just wanted your perspective on which ones of these you think has a better chance of succeeding the Insurtech space, the insurance space.
Yeah, so maybe we could do a couple of these, what's hot and what's not, right? So I think the one that is really hot right now is alternative data sources in underwriting. So if you can provide an alternative data source for an underwriter, whether it's the property and casualty side of things, or it's the life and annuities, or even if it's the health side, and it has a predictive capacity that can better improve underwriting profits, that is extremely hot right now. Every carrier we talk to, they are looking for that. And especially if you can do one that you don't require the entire insurance carrier's data set to analyze, but you can provide something that's additive to them, that is probably a home run. So that's what's hot. What's not is blockchain. So blockchain was in 2017 a really hot area. And I know because with SVIA, we ran an event which was insurance and blockchain focused in Silicon Valley. And we brought a lot of the major players. So the Institutes has a group called the Risk Stream. It used to be called the Risk Block. And they pull together a lot of carriers that are part of that. AAIS Association has a blockchain methodology that they're creating. And then back then there was a group called B3I that was led by Swiss Re. They were all doing blockchain and distributed ledger technologies R3 was in its early evolution. And it was something people are really interested in. That people are willing to travel cross country to learn what's going on with blockchain. And I think that was in parallel, if people remember back to when Bitcoin ran up from basically around $2,000 to $19,000. And I was in the heat of things. I was really interested in it, not just from the running the event perspective, but I figured I need to know something about this. So I started a Bitcoin mining farm in one of my rental properties. We mined Ethereum as well. So I really dug into the technology aspect and kind of geeked out on it. But it was weird because not only did the crash happen when Bitcoin went from like 19,000 back down to 4, right? Which a lot of the people that are in the hype now don't even understand the level of magnitude of that crash. But also the level of interest along carriers really faded too, because they had done a few of these proof of concepts and realized that the universe of applications that actually make sense is not that big. In general, fintech and banking, it's much bigger because it's transaction based. But insurance, unless you're doing a subrogation application, you're doing a transfer payments like between reinsurers and insurers, or you're doing some type of proof of insurance, I would say that there's very few practical applications to blockchain. So when the hype died down and the proof of concepts didn't really pan out, or people realized that you needed a lot of insurance carriers to actually make it work, it just became too hard of a problem. So blockchain is currently sitting in the it's not category. There's definitely some startups that will be successful using blockchain, but if you're a founder and you're pitching to investors and leading with blockchain, especially to insurance investors, it's not going to give you an advantage. If anything, it's going to give you a kind of scarlet letter. So I'd say be careful.
Got it. Got it. Great answer. Great answer. Well, awesome. So let me go now to the next section of this podcast, which is getting to know a little bit better David, right? Who David is all about. So what the one question that comes to my mind is, if you were to reflect back in your journey, personal and professional, right? What do you think is your biggest achievement and your biggest learning so far?
That's a great question. So I think, I know this sounds weird to go in this direction, but I would say from a personal perspective, one of my recent greatest achievements is actually, while I've been doing all of these things that we mentioned, going through law school and passing the bar. And
Oh, wow.
that was honestly, studying for the bar exam was one of the most difficult things that I've ever done. I actually studied more for the bar exam than I did in my entire undergraduate career. And I would say the attorney thinking is very different for me, because I was an undergrad both on the business side, but I kind of think of myself as an engineer, an industrial engineer. So going from an industrial engineer to an attorney is just a completely different world. Like, obviously, I'm interested in writing, I'm interested in communicating. Actually, in high school, I was the captain of the debate team. So a lot of people from debate became attorneys. But I would say it was shifting from one side of the brain, right, the analytical and math side of the brain, to the purely verbal written side of the brain was a big change for me. And actually, some of my really good friends from law school did not pass the bar the first time. So I was very fortunate. I only passed by 2 points above what you needed to pass. So I want to say I studied just the right amount, but obviously I was doing that while I was growing Insurtech New York, which was very difficult. So I'd say that would be probably one of my greatest achievements recently. One of my biggest learnings, I would say, so the one business that I ran alongside Hatch House Ventures was Helium IQ, which was a software company. And I think the learning I would have from that is, because we ultimately at the end decided to shut down the company. And the big learning that I had from that, well, maybe two. One is that you have to be extremely capital efficient as a founder. And we made the mistake of listening to our investors. So when we were growing the company, we had the option to either kind of spend in technology development at either a small pace or a faster pace. And of course, our investors want us to get to exit faster. They're like, spend at the faster pace. And to the point that we talked about earlier about really learning the market, we spent on development faster than we spent on learning in the market, which caused us to spend through all of our money faster than we knew exactly what we wanted the product to be. So we were at a point where we had to make a decision: do we want to raise more money and try and really figure it out? Did we want to raise more money to kind of market what we have? And our one big competitor in the space, which is also the second lesson, they were rapidly gaining market share. They took on the Ivy League schools very early on. And they were also in market before us, and they were more capital efficient because they basically got kids in college to develop their product at a very cheap cost. So we just couldn't really compete with them. And that's kind of the second lesson, is like, you have to have a big enough market size. Our total market size when we originally investigated, it was probably somewhere in the 100 to 200 million size. But when we really talked to customers and found out how much they were willing to pay and who was actually our buyers, ended up really being only 10 to 20 million in terms of the maximum possible revenue we could have if we had the whole market. And it was kind of a winner take all market. So we ended up essentially deciding that we could have gone through with it, but like the winnings, like if we essentially captured all of the market, just wasn't enough, at least for me, to justify continuing to grow the business. So we rather essentially shut it down, make sure the investors lost the least that they possibly could, keep our good relationships with our customers by actually introducing us to our main competitor and saying, hey, like, we'll onboard it, building a good relationship with our competitor. So it was a good transition and kind of transitioning out of the business. But I think that personally was a very difficult thing to me. Like, one of the most difficult things is to call your investors and say, look, like, you're going to lose your money on this one. And we did our very best. I mean, both my business partner and I didn't take any money out of the business. We didn't take a salary or anything. So it was very difficult. We were as capital efficient as we could be, but because we had a development company that was outside of our four walls and it wasn't us being the developers, we just weren't as capital efficient as the other companies. So I would say the two big lessons for that is be as capital efficient as possible, and also go after the bigger markets where if you have to raise more money, it's justifiable because then you can grow into the market opposed to a super small, super niche market.
Got it. Got it. Those are great achievements and learnings. And just on the learning side, out of curiosity, I wanted to know if you were to sort of go back and revisit, that particular startup. Obviously, the two reasons why you shut it down are, things you would explore. But from a time taken for you to decide, right? Like, how long did it take for you to make that decision to actually shut down the company versus wanting to shut down the company or thinking about it?
So the interesting thing, and this is one dynamic a lot of people don't realize, because if you pull back the curtain, business is made up of its founders, right? So my business partner, Steve, and I were the founders of the company, right? So generally the assumption from the outside is that both founders have the same perspective and both founders believe the same thing all the time. And that's not always the case. So I would say, disenchanted from the business much sooner than my business partner, Steve. Like, he liked the idea of just running a startup and being a founder. He also liked the space because not just did he do our business, but we sold some consulting. So we actually ran the entrepreneurship department for Rowan University in New Jersey for an entire year. He was kind of their interim entrepreneur director, which helped us get the software in. And it was a great thing, right? So he enjoyed all of those aspects of it. He taught entrepreneurship at a number of schools, which gave us a lot of credibility to be a professor, to be an entrepreneurship director, and all of these things. So he loved the space. For me, the reason why I was originally interested in the space is because I had been part of a startup when I was in college in the ed tech space. So I liked it. And this was kind of like another chance to go back into it with a little more experience and a little more knowledge. So I had liked that aspect of it, but I wasn't totally sold on who our customers were and what value proposition we were providing. And frankly, just the education space and in general, it just like wasn't a space that I was super excited about. It's not a space I'm excited about as insurance. Like some of the people in the education space, as you could imagine, because they have PhDs, they have an ego. They have some level of arrogance. They have this perspective that they know the right way, whether they know any other way beyond their own way. Versus I think in the insurance space, people are so much more collegiate, they're cordial, because someone at AIG might be someone at Chubb a few years later, might be someone at Arch Capital. So you have to be friendly because everyone is kind of in the same bucket where they're either distributing the product, reinsuring a product, they're co-developing a product. So the ecosystem is so much more overlapping versus in education, students generally only go to one school. And if they transfer to another school, that's a bad thing, right? So there's this kind of competitive nature. Like there is some cordiality. People obviously go from being an entrepreneurship director at one school to another school, but it is not as kind and friendly as the insurance industry. And I think ultimately, the value universally provided by the insurance industry is to all people in the entire world, right? It's a global industry. It helps a lot of people. But in the education space, it's a little bit different in the sense of it's more wealthy people go to better schools, right? And it's exclusive, right? So the entire universe of people don't necessarily benefit. And there's a lot of debate in society now whether sending everyone to a four-year college is even the right thing. And if you look at all the debt that is accumulated, the $1.7 trillion that students have taken on, if you think about it, that is kind of an aggressive or parasitic thing the universities are doing. So I think as much as I like the industry and I like how universities help entrepreneurs, right? There is a lot of the innovation or entrepreneurship theater where you have someone with a PhD in entrepreneurship trying to teach an entrepreneur, and they never started a business in their life. And that like disingenuous nature of it just didn't sell me. So I think I got disenchanted earlier. So to go to answer your question, the whole process took a year, but I was kind of checked out of the business ultimately a year before we shut it down. I didn't feel like I was doing anything wrong by our investors because they knew that I was not taking any money out of the business. So I had to be doing other things to make money at the time. And I disclosed that to them and I was very clear. So I felt like I could uphold my fiduciary responsibility. But in the same sense, I had kind of mentally checked out and decided that before my business partner, Steve, kind of realized that it was inevitable.
Got it. Well, thank you for all that additional background and context into, the why along with like how and the what. So by the way, your passion for EdTech comes loud and strong and clear. I don't know. I know Insurtech is going to do well having you within it, but I can see, maybe you cracking some problems and huge problems the EdTech space is presenting. And EdTech is hot now, right? So we're seeing so much action now in that space too. So, well, on that front, question for you in terms of you're a person with so many different interests and backgrounds, and you, I'm assuming, need to keep yourself up to date with what's going around. Especially, you wear so many hats that is probably you figured out some way, some efficient way to keep doing that with all the changes and updates that are happening. What are some ways, some things you do, podcasts, newsletters, like what publications, or how do you keep yourself up to date today?
So a few things. So one is just by the nature of Insurtech New York, we are a networking business. So we have conversations with insurance carriers, Insurtech startups, investors every single day. So I am a very curious person. So when I hear something that is a trend or I hear something that I don't know a lot about, I tend to ask questions. So one of the most efficient ways for me to learn is going to events like Insurtech Connect, having conversations every week with people and asking the questions and being a curious individual. So that's kind of like the everyday. But in terms of like more specific things that I do or read or follow, so naturally my LinkedIn has become a very curated place to find the right articles to read from the insurance journals, the carrier managements, the coveragers of the world. So I kind of use that as a springboard to ultimately find articles. I use a software called Pocket. I don't know if you're familiar with that, but it's an app for the iPhone. But that does a lot of good automatic curation for me to kind of know what's going on in the world. I am not the type of person that sits down and watch TV. I don't even have a TV in my house. So you don't see me watching CNN or CNBC or Fox News. What I do is I have XM radio, so I listen to Bloomberg. I feel like the best way to learn about the world is through the financial markets. So I listen to Surveillance in the morning and many of the other stations on Bloomberg. I think that gets me up to speed really quickly. I'm a reader of Yahoo Finance. From a personal kind of education outside of the specific universe of insurance and finance and just what's happening in the world. A couple podcasts I like to listen to is I'm a big fan of NPR. So I listen to Radiolab. They're a very good podcast to kind of dive into any different topics. Like the one that I was recently listening to was the history of the mixtape and how it goes all the way back to World War II. And basically the reason why it was created is because one of the people in basically the UK intelligence division discovered that at night the Germans were playing orchestras, and he said, how is this possible? Because at the time, recording on the records wasn't good quality. So essentially they had developed a more advanced way to record on tape, which at the time recording on tape was very low quality in the 30s and going into the 40s. He discovered their technology post-war. He brought it in and in partnership with Bing Crosby, who was one of the musical talents and actors of the time, and basically left, I think was NBC to go to ABC to just essentially be able to do his show recorded instead of on air. Needed a technology to be able to do it because they were losing their ratings doing it in the low tech technology in the time. So they switched to tape. And but that's how I learn about those types of interesting stories as I listen to Radiolab. I also like listening to Planet Money. In terms of like health and wellness stuff, sometimes I'll listen to Bulletproof Radio and kind of flip through the different types of health and wellness podcasts and topics. A person I actually really like reading recently is David Sinclair. He wrote a book called Lifespan, which talks about kind of the future of how people can live longer and the latest and greatest new technologies and the things that matter to actually increase your lifespan. So things like high intensity interval training and exposure to high or low temperatures to actually activate your sirtuins, which are the repair mechanisms for DNA, and then having just a low carb or low calorie diet. So those have been some of my recent learnings. And then of course, I'm a big fan of Malcolm Gladwell. So I've been reading some of his books recently, like Talking to Strangers. So that's kind of some of the places where I go to learn and read and find out new things.
Awesome. As usual, a very comprehensive answer and a very unique answer. I've rarely come across people who don't have TV and don't watch TV. So you're certainly a unique person from that standpoint. So with that, I've come to the last section of this podcast, which is where I'm going to ask you a question, and you have to tell me who comes to your mind and why. Your favorite person as it pertains to the world of sports.
That's a good question. So my favorite person as it comes to the world of sports is actually Jeremy Bloom. I was fortunately enough to meet him at a conference at the University of Pennsylvania. So for those who are not familiar, he played football as a professional football player. He's about my height, 5'8", which is pretty impressive. He played for some of the Pennsylvania teams, but while simultaneously being an Olympic athlete in snowboarding, which you would think snowboarder, football seem like completely opposite skills. And then he went on after his career to start a digital marketing agency that became very successful. So I think a lot of athletes kind of get caught up in athletics, but don't make the transition to being business people. So I would say he's definitely an inspiration. And personally, like snowboarding is my sport. So definitely an inspiration to always push me to be better as a snowboarder.
Awesome. Same question. Favorite business leader?
Yeah, so favorite business leader. So I will pick one that probably most people don't know about. So he is actually an alumnus of the same school I went to, which I'll allow you to look it up to figure this out. But his name is Zane Pilzer. And he started a company called Zane Benefits, which was, I would say, Insurtech before his Insurtech, and had a very successful exit. He started over 21 businesses. I think 5 of them he brought public. Was involved with one of the early companies that made CD-ROMs. He is a well-written person, and I think he's published something like 8 books, which many of them are worth reading if you want to look into them. Some on entrepreneurship, some on health. He is also a snowboarder. He lives in Park City. And other interesting facts about him. He became a millionaire at 25 by making money in real estate. He actually made more money in real estate than his first job in Wall Street by essentially buying houses in Long Island and then renting them out to his friends, because his story was all the cool kids would find a house where they could kind of rent together. He was not cool enough to make it into any of the houses. So he realized maybe this is an opportunity. So he bought a house and then rented it out to all the other not cool kids and made it into a very successful business.
Awesome. And then favorite political leader?
Favorite political leader. So I think this should be a lot of favorite people's political leader, but I would probably say Nelson Mandela. And I think he's just really a true inspiration, because if you think of kind of his roots and continuing to really help solidify society, I think just really important, charismatic person.
Got it. And finally, who would be the historical figure that comes to your mind? So not in the current generation, but a historical that you would want to be looking back.
I would want to meet Ben Franklin. I think the amount of inventions that he's had, and not just that, but ultimately being a founding father, being part of the early creation of the country, I think that there's just so much you could learn from someone like that.
Great answer. Well, with that, David, we come to an end to this broadcast. Any final words from your side before we wrap up?
I just wanted to thank everyone that spent an hour listening to this podcast. And if anything that I said was either unclear to you or inspired you with a question, feel free to connect with me on LinkedIn and reach out, and happy to have a conversation and see how I might be able to help.
Great. Well, with that, we come to an end to this episode of Purple Ponderings. Thank you, David. And to the rest of the audience, we will be back very soon with another interesting guest on a future episode of Purple Ponderings. Thank you.